Welcome to The Explainer. Today, we are diving into a truly landmark paper that took home the 2016 Frisch Medal. And it's an incredible story about how a team of economists built a virtual laboratory that completely changed how we think about one of the most personal and, frankly, most complicated markets out there, health insurance. So, let's get right to the heart of it. At the center of all this is a massive policy dilemma, one that governments and big companies wrestle with constantly. How on earth do you build a market that acts as a real safety net for people when they are at their most vulnerable, but do it in a way that doesn't just trigger a financial meltdown for everybody else? It is an incredibly high-stakes balancing act. Okay, so to really get our heads around this, here's our roadmap. First, we'll talk about the tightrope that regulators have to walk. Then, we'll meet the two big risks that are pulling them in opposite directions. After that, we'll explore the amazing digital marketplace they built to study these forces. We'll weigh the surprising trade-offs it revealed, see how it created a whole new policy blueprint, and finally, we'll talk about the tough choices it leaves all of us with. First things first, let's set the stage. We're talking about regulated health insurance markets, what people often call exchanges. You've definitely heard about them with the Affordable Care Act in the US, but they're also a big deal in places like the Netherlands. The whole idea is what's called managed competition. You create a marketplace where insurance companies can compete, but they have to play by a very strict set of rules. But, and this is a big but, here's the catch. These markets are just incredibly fragile. I mean, we're not selling cars or cell phones here. The product is financial security against some future disaster. And what happens is that every time you make a well-intentioned rule to make things fair, it can have these wild, unintended consequences. You try to solve one problem and bam, you've just created a brand new one that might be even worse. And this brings us to the two main characters in our economic drama. Think of them as these two powerful opposing forces that are constantly trying to tear any health insurance market apart. One of them is pretty famous. You've probably heard of it. The other one, not so much. But as we're about to see, that forgotten one, well, it might just be the most powerful of all. And this slide just lays out the core trade-off perfectly. On one side, you've got adverse selection. This is the classic death spiral that keeps economists up at night. The idea is simple. The sickest people, who know they'll need a lot of care, buy the best insurance plans. That makes the premiums for those plans go way up, which then causes healthier people to say, no thanks, I'm out, which drives premiums up even more, and you see where this is going. The whole thing can spiral into collapse. But on the other side, you have reclassification risk, and this is the long-term nightmare. You're healthy, you do the right thing, you pay your premiums for years and years. Then you get a bad diagnosis, and all of a sudden your insurer sees you as a huge financial risk, and your future premiums go through the roof, making the insurance you desperately need totally unaffordable. And right there, that's the central dilemma. Policies that say insurers can't charge you more because of a pre-existing condition, they are fantastic at getting rid of reclassification risk. But it seems like they pour gasoline on the fire of adverse selection. So for years, the big unanswered question for policymakers was this: how in the world do you measure that trade-off? Which of these two problems is actually worse? And this is where this brilliant 2015 paper by Handel, and Whinston enters the story. Because to answer that question, they didn't just write down some theories. No, they built something. They built what you can think of as an economic flight simulator for an entire health insurance market. So how do you even build a digital twin of a market? Well, it's this really cool four-step process. First, they got their hands on incredibly detailed real-world data on thousands of actual employees, what plans they chose, their health history, their costs, everything. Second, they used all that data to build a statistical model of how we humans actually behave. How do people with different health situations and attitudes about risk make these choices? Third, they built the simulation itself, a complete virtual world with digital people and competing virtual insurance companies. And then step 4, this is the magic part. They could run experiments. They could just change the rules of the game inside this digital world and just sit back and watch what happened to the market. And the technical breakthrough here was just massive. I mean, before this, economists had models that could look at adverse selection, or they had models that could think about long-term risk. But nobody had been able to capture both of those powerful forces at the same time inside a living, breathing competitive market. This model could. All right, let's look at what this means visually, because it makes it really clear. This graph shows us a stable working market. The blue line is the insurer's average cost to cover people. See how it goes up? The more generous the plan, the sicker the people who sign up, and the higher the cost. Simple enough. The red line is what people are actually willing to pay. Now, for a market to even exist, the red line has to cross the blue line somewhere. That crossing point is a stable equilibrium, a price where insurers can cover their costs and people are willing to buy. Everyone's, well, not happy, but the market works. But here's what their flight simulator showed happens under a different set of rules, like a total ban on using someone's health status to set a price. Adverse selection gets so bad that the cost to provide insurance, that blue line, is always higher than what anyone is willing to pay, the red line. The lines never, ever cross. This right here, this is the death spiral made visible. The market just unravels, it collapses, because there is literally no price that can exist where an insurer doesn't lose a ton of money. So now they have this incredibly powerful simulation. They can finally start getting some answers. What did this economic flight simulator actually reveal about these huge trade-offs? Well, the first finding was pretty stark, and it confirmed exactly what we just saw in that graph. When they ran a simulation with what's called pure community rating, that's a rule where everybody pays the exact same price no matter how healthy they are, adverse selection was so powerful that the market completely fell apart. It just couldn't exist. But then came the bombshell, the paper's most shocking and honestly most influential finding. When they measured the impact on a person's financial well-being over their entire lifetime, they found that the pain from reclassification risk, the financial ruin that comes from your premiums exploding after you get sick, was 5 times greater than the cost of adverse selection. This just completely flipped the conventional wisdom on its head. So what all these results show is that there's just no silver bullet here. Every single policy choice is a difficult trade-off. But maybe the biggest, most profound insight was this. Looking at a health insurance market and a single one-year snapshot is dangerously incomplete. To make good policy, you have to think about it dynamically across a person's entire life. And look, this wasn't just some dusty academic exercise. This paper gave us a completely new blueprint for how to analyze healthcare policy in the real world. It forced everyone to stop thinking about eliminating problems and start thinking about choosing which problems we as a society are willing to live with. And its legacy was huge and immediate. It set a new gold standard for policy analysis by finally unifying these two competing risks into one model. It made this kind of digital twin simulation an absolutely essential tool for anyone trying to understand markets like the ACA exchanges. And maybe most importantly, it gave policymakers a way to stress test their ideas, to see the consequences of their decisions virtually before rolling them out to millions of real people. If you take one thing away, let it be this. The paper forced a fundamental shift in our thinking. A health insurance market is not some static problem you can solve once and then just walk away from. It's a dynamic system that plays out over decades of a person's life, and our policies have to respect that complexity. And this brings us to the broader legacy of this type of work, and this powerful idea we can call the inefficiency we choose. You see, this paper didn't just appear out of nowhere. It stands on the shoulders of giants. Previous Frisch Medal winners built the tools to simulate how companies compete to enter a new market or how they compete with each other for workers. This paper took that next giant leap, showing how to simulate competition over dynamic risk itself. Today, economists can build these astonishingly detailed digital twins of entire regulated markets. And this leads us to what might be the paper's deepest, most lasting insight, which is summarized perfectly right here. The real goal of regulation isn't to create some perfect, problem-free market. That's a fantasy. The real, grown-up goal is to choose which kind of inefficiency, which kind of problem we as a society are willing to accept. And this slide just puts that incredibly tough choice in these starkest possible terms. There is no perfect answer. So which one do we choose? Do we accept the inefficiency of adverse selection, where the healthy help pay for the sick in the short run? Or do we accept the far more brutal long-term inefficiency of reclassification risk, where one bad diagnosis can lead to complete financial ruin? That is the profound and profoundly difficult question that this research forces all of us to confront. Thanks for joining us on The Explainer.